Hi class, welcome to lesson number 39. We talked in the last class about money supply, money demand as well actually, and the homework question was about money supply. And we talked a little bit about the fact that money supply by the Federal Reserve is divided into three particular sections, M1, M2, and M3. The way it's arranged is based on its liquidity, right? So M1 starting off with the most liquid, okay, to M3, which is the least liquid, okay, least liquid. And each of these sections of or classifications of money supply holds different categories of assets or money. Okay, M1, obviously the most readily available and the most liquid, okay, holds cash, coins, checks, and checking deposits. Checking deposits, okay. Checking deposits. All right. What about M2? What does M2 hold? M2 holds M1, okay, plus, okay, M2 holds saving deposits because you get interest off of that and you might have to pay a penalty for that as well. Saving deposits, right, where you're earning interest. And also small time deposits, and by small we mean under $100,000, okay? Small time deposits. Although $100,000 sounds kind of big if you ask me, but small 100,000 is under 100,000. Okay, so I guess not 100,000 exactly, but under 100,000. Okay, so $99,000 would still be a small time deposit. All right, you get the point. Now let's talk about last one, which is M3, which is the least liquid out of the three. Okay, and M3 includes M1 and M2, right? But it also includes large time deposits. Time deposits. So these are time deposits over $100,000. Okay? So as long as you know that money supply is divided into M1, M2, and M3, M1 is most liquid, M3 is the least liquid, what they each hold, you'll be fine. Also, one of the important things to talk about when we talk about money supply in the money market in general, we generally refer to M1, okay? Because M2 and M3 are not as readily available in the market, okay? So keep that in mind, and this is money supply. With that being said, let's get into the new stuff, okay? The new market we're going to talk about is the money market. Now, before I draw the money market, I want to talk about a couple different things. One is, do not get this confused with the market for loanable funds. The market for loanable funds is a different market because it includes the amount of money that, yes, that is being loaned, but the money market is a far more inclusive market, right? It includes all sorts of things. It includes checkings. It includes currency. Say that you put $100 in your closet. The money market has that $100 accounted for, but the loanable funds doesn't, because the loanable funds only accounts for money that has been put into the banks, which the banks have loaned out. Okay, so what about the saving deposits? What about the reserves? All of this is accounted for the money market, but not in the loanable funds. So the money market, if you imagine, is a lot bigger than the market for loanable funds. So that being said, let's go ahead and draw the money market. Right, the money market has two things. It has the money supply and the money demand. Right, money supply we talked about M1, M2, and M3, but the one we account for is M1 because that's the most liquid, and we can account for that immediately. But M2 and M3 have sort of this timed consequences, so we can't as readily cash in those assets. So let's draw money market. Money market, right? And we said obviously you have a demand and a supply as usual. So what are the X and the Y axis for a money market? The X axis is the nominal interest rate. Okay, so what is the interest rate in the market today? It's the nominal interest rate. So if you go out and you say you want to get a house and the banker tells you it's a 5% interest rate, that probably is a nominal interest rate. Okay, so you have a money demand, downward sloping like almost all demand graphs. Okay, on this axis On this axis, the x-axis, excuse me, you have money. Okay, pretty cool. Money supply is constant, and for that reason is a vertical line. Okay, money supply is not downward sloping, so it does not vary depending on the nominal interest rate, right? It just is a constant supply of money. Okay, this is a constant number. Okay, so this is a, this is a finite number. Okay. So what does this equilibrium mean? Okay, when money supply meets money demand, what is this equilibrium right here, right? So we have a particular amount of money in the market, okay, as a whole, and then we have a nominal interest rate, okay? This, according to Keynesian economics, is called as the price of money, right? Okay, so let's go back to our example. You are living in Southern California, okay, and you want to buy a house, all right? And you say, well, I don't have the entire money of, let's say, $1 million. I want to loan out, I want to put in about $100,000 in, and I want to loan out about $900,000. So where do you get that loan from, okay? Well, you go to the bank. You go to the bank and you say, hey, I want $900,000. The banker says, fine, but you can't just walk away with $900,000. We all wish we can, right? But we can't. So you got to pay money for money, right? And that is basically what this price of money is. The interest rate when you go to the bank, when the banker tells you, ma'am or sir, you have to pay 9% interest rate, okay, or 10% interest rate, what they're trying to tell you is that's the price of money, okay? In order to get that $900,000, right, they're saying you got to pay 10% on top of that. So 10%, $90,000 is the premium you pay for this money. Okay, so what Keynesian economics say is that, hey, this money supply and money demand have an equilibrium. Okay, this equilibrium dictates an interest rate. That interest rate is the price of the money. And this is what you mean by the price of money. When you go out to the bank, you ask for a loan, they tell you your interest rate, all of this dictated by this equilibrium. Okay, so let's, we talked a little bit before, just verbally, but let's actually put it down on paper and let's talk about the differences between money market and loanable funds, because I don't want you guys to get confused between the two, okay? And so let's talk about the differences. So I'll just move over here and let's talk about the money market versus money market, which we just talked about on that side, versus the market for loanable funds. We've talked about this a lot of times before in classes, in previous classes, right? Market for loanable funds. All right, so what's different? Well, money market is a lot bigger, okay? It's a lot bigger. Again, the money market is a lot bigger. Two is that, well, before I actually jump into two, let me actually talk about why it's a lot bigger. Okay, we talked about the fact that, okay, listen, the market for loanable funds includes the supply of funds that's available by the banks, right? So you go to the bank, out of $100 that you get, okay, so you make $100,000, okay, you make $100,000. Out of that, okay, tax, let's say, takes away $30,000, okay, and you get home $70,000. Out of that, you consume $50,000, right? And you save the rest of $20,000, right? You save $20,000. This $20,000, right, you put in a bank, okay? Let's say the bank is required to put 10% as reserve, okay? So they only need to put 10% at any point in time. So only $2,000 of it is actually within the bank. Now the way the bank makes money is the rest of it, the $18,000, right? They actually loan it out. Okay, I went a little fast, so let me slow down and let me go again. You make $100,000. This is your income. Okay? Out of that, you get taxed $30,000. Okay? The rest of it is your disposable income. Your DI is $70,000. Your DI is made of two things: consumption and savings. Consumption, I said, is $50,000. Saving, I said, is $20,000. All these numbers, by the way, are made up, so don't be wondering how I got this number. I just made it up, okay? So $20,000 is your saving, right? Out of that $20,000, you put it in a bank, okay? The bank is only required to put 10%, okay, into their reserves, and the rest of it they can loan it out, which is how they make their money. So $2,000 is in the bank, $18,000 is being loaned out into the supply of loanable funds, in the market of loanable funds, okay? Now, what about this market of loanable funds only includes $18,000. So what about this $2,000 in the bank, right? What about that money that is in the reserve, right? What about, let's say out of this $50,000 that you've consumed, right? Let's say that maybe about $500 is somewhere in your house. How does that get accounted for, right? So the supply of money in the money market accounts for all of that. The market for loanable funds only accounts for the money being loaned out, which is a smaller amount than the whole money supply, okay? So remember, guys, that money supply accounts for more things than the loanable market for loanable funds, right? Namely the currency that's been sitting at your home, namely the accounts that are in reserve in banks, right? So it's a lot more inclusive, it's a lot bigger. All right, so it's a lot bigger. All right, let's talk about the second point. Second point is that let's talk about the demand in each one of these, okay? So I've said this probably 1,000 times, but I'll say it one more time, right? The demand in the market for loanable funds right? Loanable funds is basically the investment is equivalent to the investment demanded, okay, by the firms, right? Because they need to invest in different things. They need to invest in machinery. They need to invest in different projects because they want to make money and they want to make profits. And the way they do that is they invest money. And so the demand function in the market for loanable funds is actually the investment demanded by the firms, okay? So what about this demand in the money market? What is that? Demand in money market, okay? How is that different from the investment demanded that is present in the market for loanable funds, okay? This demand for money is actually equivalent of this demand in the money market includes the investment demanded. It also includes for consumption. And remember, consumption happens to be the biggest part of GDP. Okay, biggest part of GDP. So by far, it's a lot more inclusive than the market for loanable funds. The demanded money market is a lot more inclusive because it includes for consumption. Also, it includes for asset demand. Okay, includes for asset demand. Again, if you want to have that money at home, right, it includes for that. Okay. So one of the biggest things, one of the biggest differences is this part of this consumption. Okay, it's huge, right? There's a huge difference because one only includes investment, the other one includes investment as well as consumption, which is the biggest part of GDP. So a lot more inclusive in that way as well. Okay, so we've kind of differentiated the fact that the money market is a lot bigger than the market for loanable funds. Okay. So that being said, let's jump in a little bit into monetary policy. Before I jump into monetary policy, let's we've talked about the money market, right? We have a money market graph to my right here, right? And basically, money market graph. If you look at the money market graph, here we have a money supply, right, and a money demand. Okay, a money supply and a money demand. Now, here when you have a money supply and a money demand, right? You have an equilibrium. An equilibrium, it dictates the price of money. Basically, equilibrium is the interest rate at which you can borrow money, right? Okay, so we have understood a couple of things. This is a bigger market than the market for loanable funds because it includes a lot more things. The demand includes consumption. The money supply includes reserves in banks, includes checking accounts, right? Supply is bigger, demand is bigger. Money market is different than the market for loanable funds. Fine. So now let's think about differences. Like money demand is something that the government cannot control. But what can they control? They can control this factor over here, money supply. All right, so before we start thinking into how the government manipulates the money supply, let's try to see what happens when we do shift the money supply, okay? Kind of a reverse order, okay? But let's do it anyways. All right, let's try to see if we shift the money supply. Okay, how does this affect my interest rates? How does this affect the money being loaned out? Or excuse me, the money in the market. So let's say my money supply goes to the right, okay? We have increased, as the government, we have somehow increased the money supply, okay? I'll tell you in a bit how this is done. Okay, so I call that MS1, the line to the right. Double arrows showing that the money supply is shifted to the right, okay? Now the same money demand line, but a new money supply. We have a new equilibrium right over here, right? This point over here. So the amount of money in the system is increased, right? You can see that difference, right? If this is M2, this is M1, you can see the difference in the amount of money in the system. Another thing is that, and most importantly, is the fact that the interest rates have actually dropped. The interest rates have dropped. Why is that? Again, pretty simple theory, right? If you have more of something, that particular thing becomes less valuable. It becomes less valuable, all right? So same thing with money, right? So say the government increases the money supply, okay? My interest rates come down. My interest rates come down, right? So why does that really happen? Well, I have more money in the system. Money's less valuable. Interest rates have come down. So we're with you that far, okay? But there are two questions that come up. Well, is it as easy as saying that if there's something more of something, it becomes less valuable? Well, on a generic level, yes, it's true. But more importantly, how does this happen? How does the money supply shift to the right? And how does the government do this? And that's something we'll try to get into a little later. But it has to do with bonds, okay? It has to do with bonds. Basically, if you're increasing the money supply, the government is pumping in money into the system. So if we want to decrease the interest rates, okay, I'm going to erase this part, and then we'll talk about it in this sector, and then I'll move it back to this part. But for now, let's erase this, and let's talk about some basic conclusions that we've gotten here. So we said that if the money supply increases, right, the interest rates drop. If the money supply increases, interest rates drop. That's because if there's more money in the system, money becomes less valuable, okay? And it's cheaper to borrow money because there's more of it, right? Let's give you an example. Let's say that I have one car, okay? And everyone wants to borrow my car. And, well, I charge $1,000 to borrow my car a day, okay? Because there's only one car in this whole city for some reason, okay? One car in the city, and I have that car, and it's $1,000 a day. Pretty hefty premium, right? Pretty hefty price. Kind of overvalued for renting a car, right? But what if there are 1,000 cars in the city? Okay? This is really simplified, okay? But let's say there's 1,000 cars, resources have multiplied by 1,000. If I divide this by 1,000, right? Significantly less a day. Right? Maybe not $1, okay? Obviously, it's a little drastic of an example. Point is that if I have more of something, it becomes cheaper to borrow. Similarly, when I have this equilibrium and I shift the MS to the right, when I shift the MS to the right or the money supply to the right, there's more money in the system. It's cheaper to borrow money, right? And interest rates come down, okay? The exact mirror effect is when money supply goes to the left or money supply decreases, right? If money supply decreases, okay, obviously the mirror effect would be the interest rates go up. Let me go to this part of the board and I'll show you graphically how that works, okay? So in this case, I showed you how money supply, if it moves to the right, interest rates come down, okay? Now, let me show you what happens when the money supply actually goes to the left. Okay, money supply goes to the left. We have money supply, not so straight line, I apologize. We'll call it MS3. Actually, you know what? I only used MS1, so I'll use MS2 right now. Okay, I'm sorry about that. So MS2 is the graph, the line left of this current one, MS1. So MS2 shifts to the left, and look what happens, right? We have a new equilibrium right about here, okay? And if you look at it, right, your money has shrunk in the system. Money has gone to the left, it's gone down. And interest rates have gone up, exactly what we talked about. If there's less of something, right, the example that we had was if there's 1,000 cars in the city versus 1 car in the city, okay, it's going to be more expensive if there's less of something, right? If there's less of something. So, you know, platinum or gold versus, let's say, water, obviously there's going to be a difference, right? Because there's less of gold than there is of water, okay? So that being said, if there's less of something, it becomes more valuable, less money in the system. If the money supply is shrunk, we have increased the interest rates because of this new equilibrium. All right, I get that point. Now, how does the government take away money? How does the government shrink the money supply, increase the money supply? Is something we're going to answer in this lesson partly, but mostly in the next lesson. Okay, so let's talk about. Let's talk about banking a little bit, okay? Let's talk about banking a little bit. Before I do get into banking, I think I can go ahead and give you a little trailer of how monetary policy works, okay? I want you guys to think about it a little bit, because since I've talked about money supply and the way it works, I will write down the 3 key tools that the government uses in terms of controlling monetary policy. So you've talked about okay, we have talked about fiscal policy, right? We said fiscal policy, well, government can, when it comes to fiscal policy, government can spend more, tax more, or government can spend less and tax less, right? And then we can control AD, okay? There's also supply side economics, and we can control AS, okay? And the way we can control AS is with taxes, okay? But that was fiscal policy. Fiscal policy used these tools to control the economy. Now we have a new thing called monetary policy, which uses the money supply. Again, we cannot control money demand at this point, right? We only control money supply. And the way we control money supply and the way we handle the economy using money supply is using 3 different options. Okay. First is that, and this is not in terms of importance in any means, but I will tell you the most important though. But let me start with one of the options being change the discount rate. Okay, so discount rate. Discount rate. I will define these and help you out with all of these, but first let's talk about these and just name them, okay? Discount rate. Second is the reserve ratio. And don't worry if you don't understand any of these, because I will explain each one of these a little later. And lastly, and most importantly, I'll put a star next to this one, is something called as open market operations. Okay, this OMO stands for open market operations. And remember, guys, I told you that handling money supply has to do something with a word called bonds, okay? All right, so open market operations is all about bonds, okay? It's all about purchasing bonds, selling bonds, and we will get in detail. The discount rate is something that we will talk about later, but discount rate basically is the rate at which that the Federal Reserve can, or the government, like loans out money to the bank, okay? So if the banks need money because they don't have enough money in their reserves or for whatever reason, they borrow from the Federal Reserve Board, and they actually happen to control the discount rate, okay? The reserve ratio is a ratio that dictates each bank how much percentage of their money should be in reserves, right? How much percentage of their money should be in reserves. And it's this guy right here, reserve ratio, that makes me want to talk about banking now. Okay? So the reason why we started about monetary policy a little bit is that I want you guys to think about monetary policy. Since we just started talking about money supply, I also want to just go in a little bit into monetary policy. And don't worry, again, we'll talk about those three in full detail again in the next class. For now, let's talk about banking. Okay? Let's talk about banking because we talked about reserve ratio, and I've been talking about reserves a lot, so we might as well get into banks. All right, so imagine yourself as, I guess Joe the Plumber was famous in the last election, so we can talk about Joe the Plumber, right? And he invests, he makes about $100 a year, okay? Well, we can be more realistic or for whatever reason, all right? Let's say that Joe the Plumber makes $60,000 a year, okay? Makes $60,000 a year. What he does is that he takes the $60,000, okay? And again, remember that if this is your income, you have your disposable income, and then you have your tax, okay? Let's say he gets taxed, okay, at, let's say 20%, okay? He gets taxed at 20%. Well, 20% of $60,000 happens to be $12,000, okay? The other one happens to be $48,000. So Joe the Plumber has $48,000. And let's say out of that $48,000, he happens to have $18,000 in savings and about $30,000 in consumption. Okay? $30,000 in consumption. So this savings, $18,000, Joe the Plumber puts it into the bank. Okay? He puts it in the bank. All right, so the point is that this $18,000 that we talked about does not have to go completely into the bank. Okay? So if Joe the Plumber decides that, hey, you know what, I want to invest $18,000 into the bank, that's fine. What the bank does is that it doesn't have to keep this $18,000. The federal government, okay, the federal government of the United States, right, what they say is, hey, listen, Bank of, let's say, Illinois, okay, Bank of Illinois, you have to only keep 10% of your money in reserves, okay? Only 10% is reserves. And that's the thing we talked about. We said reserve ratio is something that they control. And we'll tell you how that affects the economy a little later. But for now, understand that the Federal Reserve says 10% is a reserve ratio. Okay? The reserve ratio. Or known as RR. Okay? RR. All right? So reserve ratio is 10%. So let's take this Bank of Illinois, okay? So Bank of Illinois gets a check for $18,000 from Joey the Plumber, and they say, well, you know what? Only $1,800 is required to be in reserves, okay? And the rest of it, right? The rest of the $1,800, the rest of, let's say, $17,200, okay? Actually $16,200, excuse me. The rest of $16,800, we can actually, it's an excess. We don't have to put this in our reserves. So what they do is, let's say John comes in, and John comes in Bank of Illinois, and he says that I need to start a new company. I actually need about $16,200 in loans, okay? So what the Bank of Illinois does is actually it loans out that $16,200 in loans. All right. So in effect, what they do is they loan out Joe the Plumber's money to John for loans. All right. So they only have to keep this amount in reserves. The rest of it goes to loans. We'll tell you in the next class how that comes back and it creates more money. Okay. But for now, I will have to leave you with a homework question. The homework question is as follows. Please tell me the two graphs that, or rather, please draw the two graphs of two scenarios. First scenario is that the money supply increases in a money market, and second scenario is the money supply decreases in a money market. Okay? What are the consequences to the interest rates? I'll say that one more time. Draw me two graphs, money supply going up and money supply going down. Tell me what happens to the interest rates. With that question, I'll see you guys in the next lesson. Thank you so much for joining. Take care.